The story of Warren Buffett transforming Berkshire Hathaway is not just a business story. It is a blueprint of how real wealth is built through thinking, discipline, and strategic positioning. When Buffett took control of Berkshire Hathaway in 1965, it was not the powerful empire we know today. It was a struggling textile company facing declining profits, rising costs, and brutal competition from global markets. Despite years of effort, the business could not generate meaningful returns on equity. This is where most investors make a critical mistake. They try to fix weak businesses instead of recognizing structural limitations. Buffett realized that textiles were a commodity business with no real differentiation, no pricing power, and no long-term advantage. That realization became one of the most important turning points in his career. Instead of emotionally holding on to a failing model, he shifted his thinking towards something far more powerful: capital allocation. He understood that the real opportunity was not in running the business itself, but in deciding where the money generated by that business should go. As Buffett observed the company more closely, he noticed something extraordinary. The small portfolio of stocks owned by Berkshire Hathaway was generating significantly better returns than the entire textile operation. In fact, the investment returns were multiple times higher, even though they required far less capital. This insight changed everything. It revealed a fundamental truth that most people ignore. The real power in investing is not in effort, but in allocation. Buffett began to focus less on trying to fix operations and more on deploying capital intelligently. This shift in mindset laid the foundation for what would later become one of the greatest financial machines in history. Instead of being trapped inside a low-return business, he started redirecting capital into opportunities that could compound over time.
This is a key lesson for any serious investor. Your success is not determined by how hard you work, but by how effectively you allocate your resources. The real breakthrough came when Buffett entered the insurance business, a move that completely changed the trajectory of Berkshire Hathaway. At first glance, insurance may seem like a simple or even boring industry, but Buffett saw something that others did not: the concept of float. When customers pay insurance premiums, that money is collected up front, while claims are paid later. This creates a pool of cash that the company can hold and invest in the meantime. This float is essentially money that does not belong to the company, yet it can be used to generate returns. Buffett realized that if he could control large amounts of float and invest it wisely, he could create a self-sustaining investment engine. This was not just about earning profits. It was about building a system that continuously feeds itself with capital. With the acquisition of insurance companies, Berkshire Hathaway was no longer just a business. It became a financial ecosystem capable of generating and compounding wealth at scale. One of the most powerful examples of Buffett's strategy was his investment in GEICO. He had studied the company early in his life and understood its unique advantages, such as focusing on low-risk customers and operating with lower costs by selling directly. However, when GEICO faced severe financial trouble and its stock price collapsed, most investors lost confidence and walked away. Buffett, on the other hand, saw opportunity. He recognized that the core business model was still strong, even though the company was temporarily struggling. This is where his long-term mindset and deep understanding of value came into play. He invested heavily when the company was undervalued, demonstrating one of the most important principles in investing: the difference between price and value. Over time, GEICO recovered, grew stronger,
And became one of Berkshire Hathaway's most successful investments. This decision alone reflects the mindset required to succeed in markets: patience, conviction, and the ability to act when others are fearful. However, Buffett's journey was not without mistakes. His acquisition of General Re showed that even the greatest investors can misjudge situations. The company faced significant issues due to underpricing risk, which led to large losses. But what separates Buffett from average investors is not that he avoids mistakes, it is how he responds to them. Instead of panicking or abandoning the investment, he focused on fixing the underlying problems. He improved pricing discipline, strengthened risk management, and ensured that the business returned to profitability. This highlights another critical lesson. Investing is not about being perfect. It is about being resilient and adaptable. Over time, Berkshire Hathaway's insurance operations grew into a massive source of capital, generating tens of billions of dollars in float. This continuous flow of cash allowed Buffett to invest in high-quality opportunities, creating a powerful cycle of compounding. Ultimately, his strategy was never about chasing quick profits. It was about building a machine that produces money consistently over the long term. And that is the real secret behind his success. Another crucial insight from Warren Buffett's strategy is his understanding of the true nature of business quality. Buffett recognized that not all businesses are created equal, even if they appear profitable on the surface. In commodity industries like textiles or even insurance, products are largely identical, and companies often compete by lowering prices. This creates a dangerous environment where profit margins shrink and long-term sustainability becomes uncertain. Instead of engaging in price wars, Buffett chose a completely different path. He focused on building financial strength and discipline, ensuring that his companies only operated when conditions were favorable. If prices were too low, he was comfortable doing less business rather than accepting poor returns. This level of patience is extremely rare in the investing world, where most participants feel pressured to always be active. Buffett's approach teaches us that sometimes the best decision is not to act, but to wait for the right opportunity. A major component of Buffett's success lies in his strict underwriting discipline within the insurance business. Unlike competitors who are willing to take on risky policies just to increase market share, Buffett insisted on writing only those policies that made economic sense. He understood that short-term growth achieved through poor decisions would eventually lead to long-term losses. This philosophy became especially important during periods of intense competition when other companies were aggressively underpricing their products. Buffett refused to follow the crowd. He knew that accepting bad deals would not only destroy profits, but also increase the cost of float, turning a powerful advantage into a liability. This discipline allowed Berkshire Hathaway to maintain strong financial health even when the rest of the industry struggled. It also reinforced an important principle. Success in investing is not about doing more deals, but about doing the right deals. The concept of float itself becomes even more powerful when combined with intelligent capital allocation. Buffett did not simply accumulate cash. He deployed it into high-quality investments that could generate consistent returns over time. This created a compounding effect that accelerated Berkshire Hathaway's growth. Each dollar of float was not just sitting idle, it was actively working to produce more value. Over time, as the float increased, so did Buffett's ability to make larger and more impactful investments. This is what transformed Berkshire from a small company into a global financial powerhouse. It also highlights a deeper lesson. True wealth is built not by earning money once, but by creating systems where money continuously generates more money. This is the essence of compounding, and it is one of the most powerful forces in finance. Another overlooked aspect of Buffett's strategy is his focus on long-term relationships and stability. In the case of GEICO, the company's profitability improved significantly when it retained customers over long periods. Loyal customers meant predictable cash flows, lower acquisition costs, and higher overall profitability. Buffett reinforced this by aligning incentives within the company, rewarding performance based on long-term results rather than short-term gains. This approach contrasts sharply with the typical corporate mindset, where quarterly performance often takes priority over sustainable growth. By focusing on long-term value creation, Buffett ensured that his companies remained strong and resilient even during challenging times. For investors, this serves as a reminder that stability and consistency are often more valuable than rapid but unsustainable growth. Finally, what truly sets Buffett apart is his ability to think in systems rather than isolated transactions. Most investors focus on individual stocks or short-term gains, but Buffett built an entire ecosystem designed to generate and reinvest capital efficiently. His insurance businesses produced float, which was then invested into high-quality companies, which in turn generated more cash that could be reinvested again. This cycle created a self-reinforcing loop of growth and compounding. Even when faced with setbacks, such as the challenges with General Re, Buffett maintained his long-term perspective and focused on improving the system rather than abandoning it. This systems-based thinking is perhaps the most important lesson of all. Investing is not just about making good decisions today. It is about building a structure that continues to produce good outcomes for decades. And once such a system is in place, wealth creation becomes not just possible, but inevitable.